Welcome friends to the first hangout on IFRS. IFRS, has been in some corner understood as a complex accounting principles. But if we go into detail in IFRS, I find IFRS more scientific, more easier to understand, and the whole gamut and science of gap can be understood by understanding IFRS. IFRS began in 1973. If we go to the history of accounting, the first standard in the world was in US after Great Depression in 1929. Securities Exchange Commission had requested AICPA, American Institute of Certified Public Accountants, to prepare standards. And then other countries followed the suit, UK, Australia, and the organizations, what we call MNCs, multinational corporations, having businesses in more than one country, found difficulty in preparing their financial statement of, in different countries following different gap. So at world level, there was an accounting committee set up in 1966, where 10 countries had come together. And later on, this committee got converted into International Accounting Standard Committee, what we call IASC. And that is the birth of IFRS. The first IFRS, what we call IAS 1, which was on accounting policies, came into existence in 1974. Now, what we call GAAP, generally accepted accounting principles, is the comprehensive set of principles for recording business transactions for a particular enterprise. Now, accounting is a language to write business transactions into money terms. And so we have there are 193 countries in the world, and there are about 140 countries who have their own accounting principles, or we can say GAAP. So we have a US GAAP, Indian GAAP, UK GAAP, Australian GAAP, and like that, those countries who have their accounting principles, we call that as a jurisdiction specific or country specific GAAP. IFRS is the name itself, the full form is International Financial Reporting Standards. IFRS is a global GAAP. It is not any country specific, and this GAAP came into existence in 1973. Besides the standards, which are currently 65, after IFRS 15, which is come into existence, which replaces 2 standards and 3 interpretations, IS 11, IS 18, and IFRIC 15, and other 2 standard interpretations. We have 65 IFRS. Now, IFRS has been defined at 3 places: IFRS 1, IAS 1, presentation of financial statements, and IAS 8, accounting policies, changes in accounting estimates and errors. And the definition of IFRS, which is there in these 3 standards, IFRS means IFRS, IFRIC interpretations, IAS, and SIC interpretations. So there are 4 kind of documents, because in 2001, IASC Foundation was made as a charitable trust, registered in US, Delaware State of America, and which started functioning from London. So in 2001, IASC Foundation made a committee called IASB, International Accounting Standard Board, and they say, till we make new IFRS, we will continue with the old IAS and old SIC. So there were about 34 SIC issued. SIC is Standard Interpretation Committee interpretations. We normally call SIC, but correct technical terminology is SIC interpretations and IFRIC interpretations, because SIC means Standard Interpretation Committee. But only 8 are valid today out of 34. Similarly, 41 IAS were issued between 1973 to 2001, and out of these 41 IAS, only 26 are valid after IFRS 15 is introduced, because IAS 11 and IAS 18, they are repealed by IFRS 15. So IAS 1, we can call it IFRS IAS 1. IAS 1 cannot be called IFRS 1 because IFRS 1 is first time adoption of standards, and IAS 1 is presentation of financial statements. So when we say IFRS, if somebody says there are only 15 IFRS, I would say this is an absolutely wrong answer and 0 mark, because there are 65 IFRS, because IFRS means IFRS, IFRIC interpretations, IAS and SIC interpretations. Now let us discuss what is IFRS, how to understand it like an LKG student. Now what is an accounting? The accounting was not, the double entry bookkeeping was not invented by a chartered accountant or a certified public accountant. It was invented by an Italian mathematician by name Luca Pacioli in 1494. Now this person invented double entry accounting principles. He said for every debit there will be a credit, and in any business transaction there will be both debit and credit, and debit will be equal to credit. This person also said that all account heads in all business transactions, it is an all inclusive category, that they can be classified into 3 categories: personal, real and nominal. And he gave a golden rules, what we call personal, debit the receiver, credit the giver. For real account, debit what comes in, credit what goes out. And for nominal account, debit all expenses and losses, and credit gains and income. So what we follow currently in any good GAAP is accrual double entry accounting principles, and IFRS is also based on accrual double entry accounting principles. All our Indian GAAP, all our Indian standards, 28 standards, are based on IFRS. I have done a historical study. The first standard, IAS 1, was disclosure of accounting policies. Later on, many amendments came in IAS 1, and in the present form, it is made as a presentation of financial statements. What is our AS 13 investment was earlier IAS 25, because India is a founding member of International Accounting Standard Committee. India was also founding member of the 10 member countries of the accounting group. So understanding IFRS is very easy. Now, besides the 65 standards, we have 3 other documents. One is called Preface to the Standards. So that says that these standards will apply to commercial, industrial and business enterprises. Then we have another document called conceptual framework for reporting. Now, when we say the financial statements, in a very crude form, we say only two statements, balance sheet and profit and loss account. In IFRS, complete set of financial statement means there are 5 documents. The statement of financial position, the statement of changes in equity, statement of comprehensive income, statement of cash flow, and notes. Now, in some situations, when there is a change in accounting policy or when there is a prior period items, these 5 documents becomes 6 documents, because in that particular year we also prepare a redrafted statement of financial position at the earliest period. Now, up till now, under Indian GAAP, we follow historical cost model or transaction model, where recording of all transactions at the initial recognition means when the transaction is taking place, recording that transaction in our books of account. It is done at the transaction value. It is done at the historical value. IFRS makes a departure in that. So how IFRS and global GAAP and Indian GAAP differs is, first, nomenclatures are different. In IFRS, there is one book, this is called Part A. In my hand, this Part A is, these are the bare standards. I would call this is an act, like how we have a bare income tax act or bare companies act. So Part A of this is printed by IFRS Foundation. Then we have a Part B. Part B gives the reason, basis for conclusions. Now, in IFRS Global GAAP, balance sheet we call statement of financial position. Now, IFRS Global GAAP says the objective of balance sheet is not to balance assets with liabilities. This is not the objective of balance sheet. The purpose of balance sheet is to give a financial position of an enterprise at a particular date, and therefore more appropriate name for this statement is statement of financial position and not balance sheet. Similarly, say IFRS 3, business combinations. Now that standard says when an enterprise acquires a business, then the acquirer will record all assets and liabilities at fair value. And if there is a bargain gain, there is a gain on purchase of a business, then that will be recorded in the statement of profit or loss. In the Part B, they give a reason कि normally no seller will sell the asset below market value. So if an acquirer has acquired an asset below market value, there is a gain, and this gain is a revenue gain in global GAAP, which after studying, like I qualified in 1983, so there are 31 years which has gone after studying the Indian standards. That time we were not having all these 28 standards. I am calling 28 because AS8 research and development is no more valid. The serial number runs from 1 to 28, 1 to 29, and then we have 3 standards on financial instrument which are recommendatory. So coming back to our discussion, how to demystify the IFRS Global GAAP, or how to understand Global GAAP as a LKG student. So to understand Global GAAP, IFRS as an LKG student, what we need to do is, we should be conceptually clear that any business transaction have the account heads which will be grouped into personal, real, nominal, and debit will be equal to credit. So in IFRS, say for example IS 41, biological assets, the agriculture, the title of the standard is agriculture. Initial recognition, suppose I purchase 5 cows and the transaction value is 2000 for the 5 cows and the fair value on the date of purchase is 10,000. Now journal entry for this purchase is cows account debit or biological assets account debit 10,000 to bank or cash 2,000 and to gain on purchase of cows 8,000. Similarly, financial instruments, what we call investment, financial instruments can be either an asset or can be a liability. So financial instrument, the definition is different. So sundry debtors is a financial instrument, sundry creditor is a financial instrument, bills receivable, bills payable, all these are financial instruments. So financial instrument is a contract which is a financial asset of one enterprise and financial liability or equity of another enterprise. You know, like we say that nothing come into existence in this world without a necessity. You know, today's hangout is also out of necessity because that gives an opportunity to interact with all members and understand the subject. This was not done before 1973 because that time there was no IFRS. So the investments were recorded at historical cost. There was a person called Nick Leeson, and this person did over trading in derivatives, and the organization in which he did this transaction totally collapsed. And at the global level in 1930, a group was formed to consider, how we can record derivatives, because derivative investment definition in accounting standard 13 is what? The asset which gives dividend, which gives interest, or which gives the appreciation is investment. Now derivative do not do this. So derivative do not fall in the definition of investment, but derivatives fall in the definition of financial instrument, because it is a contract where it is a financial asset of one enterprise and financial liability of another enterprise. Now, so to understand IFRS, we need to understand the account heads. We need to understand, there are 5 elements in financial statements. Statement of financial position or balance sheet. For the sake of simplicity, I will use both terminology in IFRS GAAP and in Indian GAAP, because many of us have not become acquainted with IFRS. In committee, when I want faculty to take classes in IFRS batches, I do not find more than 25 faculties, good faculties, out of 250,000 members. We can understand what is, and the number of members who have done the IFRS courses are not more than 7,000. So therefore I am using both terminology. So statement of financial position or balance sheet has three elements: assets, liabilities, and equity. And the statement of comprehensive income. कैमरा यहाँ पे इंटरनेट कनेक्शन लगा देना इसमें। ठीक है, ये तो एडिशनल है, अगर कुछ नहीं है तो इसमें यहाँ पे नहीं हो रहा है। नहीं, अभी नहीं।